Hi everyone. Welcome to the pre-watch video on how to record the business transaction. I'll take you back to my anchor slide, which has helped us to profile the progress. So, in terms of where we have reached, um, my focus this time over the next 5-7 minutes is going to be on step 2, where an accountant, after a transaction has been done, is going to record it for its own reference. And the next step would have been to report it to the world. And on this, you have already done a couple of cases. Therefore, I am at ease. But in terms of point number 2 here, this is really a pain point. And of course, it is duly deserving because a lot of people think that accounting is synonym to something called as debit and credit. The good news is for all of you that in these classes, we are never going to talk about debit and credit. Although a lot of commerce students who are looking at this video might feel a bit shortchanged, might feel a bit disheartened because that's what they thought is accounting. Well, not for a business school graduate. So I'm going to pick up on something called as a magical equation. And that magical equation is the equation which you also have done. So this is the second good news that you're getting. So there's not something entirely new which is coming your way. Can you tell me, just think about for 10 seconds and tell me this statement that you see here, the assets are equal to liability plus equity, are from which medical report? Take a pause, take 10 seconds and think about it. I am sure you will be able to make out that this is from the balance sheet, right? The statement of resources and the sources of those funds. So this is therefore, like I said, it's nothing going to be new. And what I really like about this equation is that it could be a very good substitute for the misnomer that accounting is nothing but debit and credit. No, we are not going to talk about it. But that doesn't mean that you don't have to put that much extra effort. You have to, and you have to start thinking like a manager. And in that thinking, you have to get onto if and then analysis. If that happens, what would be the impact? And this is very, very causal relationship, cause and the effect relationship. Okay. My first thing, on this slide is why am I starting with the balance sheet thing? Why is balance sheet equation considered to be really the Makkah Madina of accounting? I could have taken income statement. I could have taken cash flow statement. So why have I chosen to take balance sheet? The simple answer is that balance sheet equation is the most holistic, most comprehensive of the three. Why I say that? Cash flow statement is going to only focus upon cash, not even all resources, not only all assets. It doesn't take into account plant and machinery if it is non-cash. It doesn't take into account any conversion of debt into equity if non-cash. So you see that the focus here is always on cash. Therefore, it's a brilliant medical report, but is grossly incomplete. Second is your income statement, where the focus is on the primary business activities, the incomes, and the cost necessary. We have done these things with as revenue and alpha and beta. Now, this is a wonderful statement to look at the performance. But again, there is a point that many transactions a business does where the performance element is missing. It's only the positioning. So let's say a business buys some raw material. Now the raw material hasn't been sold, but it has just been bought. So there is no performance angle to it. So the cash goes out of the system and raw material comes in. There is no expense so far. It's just a purchase of an asset. Now, all these important things are completely missing from this. Therefore, P&L is not really the comprehensive picture. You must be wondering, how come balance sheet is the comprehensive picture then? Now here is my point. If on any transaction cash is affected, cash being a resource is going to find its place under this head. And therefore you would see balance sheet getting impacted whenever cash is getting impacted. On the other hand, income statement, whenever there is an income or an expense, you can imagine that whose pockets are getting impacted is the owners. So imagine there is a huge amount of income that has happened. So your profits are higher, your performance is better, and who gets to get richer? It is the owner's equity. So that kind of a income is going to increase your owner's equity, and that kind of an expense is going to decrease the owner's equity. I am interested in the fact that even if it's a performance gain, you see your owner's equity getting affected. So you see that while at the beginning I said that balance sheet and every medical report is super specialized, now I'm making an alter point here that balance sheet, in addition to being super specialized in terms of the position, also gets impacted by the performance. Although I am sure that you are mindful of the fact that opening position plus the performance is equal to the closing position. So do you see that performance has an impact on the closing position? That's what makes the balance sheet a magical equation to look at the if and then analysis. Important point, people, a very, very important point that you have understood, and I'm hoping that you're absolutely clear on your understanding of what is an asset, what is a liability, when is something a capital, what is an income, and what is an expense. These were the 5 different elements. We have done that in one of the classes. Understanding of these, identification of these clear cut is super duper critical for the success of this. So what are we going to do? Whenever the business will do an activity, be it operating, investing, financing, any activity, we are going to break it down and look at the impact of that activity on asset, liability, and equity. Income and expense, I'm not repeating again and again, because at the end of the day, incomes and expense are also a sub part of equity only. Equity also known as capital. Okay, so sometimes we would use the word capital, sometimes we're going to use the word equity. Long story short, this is where the shareholders, the owners, the malik are going to sit, right? So that identification is very critical. So any activity done, you would have to threadbare decode it into smaller parts and then see how does that activity impact the assets, how does that activity impact the liability and equity. So we are going to pass the delta here, and the delta here, the impact. And you would find that these deltas will maintain a relationship like this. So delta assets is equal to delta liability plus delta equity. That's how you have to ensure. This is a very, very good, so to speak, a self cross-checking mechanism for any non-commerce graduate to find out whether his or her accounting is right or not. If this equation doesn't hold true on any transaction, you see that there is something missing. Okay. And the next thing that I'm here to introduce is something called as a double entry system. This is a little theoretical. I'm not going to spend a lot of time. It only says that any business should record a transaction only if it affects at least 2 entities. For example, I took out cash from one pocket and had put it into the other pocket. So cash comes in, cash goes out. This is no transaction. So for any transaction to get recorded, it must be entered into 2 different ledgers, 2 different accounts. So you withdrew cash from bank. At least there are 2 things which are impacted, cash and bank. Both are cash equivalent, I understand, but still cash and bank are relatively different. You bought some raw material. So on one hand, there is raw material or inventory that gets affected. On the other, there is some cash if you have made payment for that. You see that these transactions have to be recorded at least in 2. Confusion point is some people think that this double entry system means that any transaction can affect at max 2 accounts. No, it is at least 2 accounts, at least 2 ledgers. And by accounts, I mean asset, liability, equity, etc., etc. So I'm going to take a quick example, although this is for the live class, but I just want to kind of take a quick example. If let's say you buy a raw material and pay that in cash, what is that raw material or inventory for the business? That raw material or inventory for the business like fertilizers and seed for Baron Coburg, oh, that's a resource. So my resource is going to go up. What do you call that resource? I call it inventory. Let's say X. X is the value. So inventory goes up. And what went out? Oh, my cash went out. So cash is what? A resource. Another cash would like to go out. Cash goes out. So what's the net change on the asset? 0. What's the net change in liability? 0. And capital is 0. So you see that my deltas have been able to form that equation. This is what you got to ensure. So what will happen if the raw material that we had bought has not been paid for? Then in that case, your raw material will go on the asset side like an inventory. And rather than cash going out, this time there will be an obligation to pay that person, the supplier, tomorrow. And that obligation, a supplier, we can formally call it as creditor, we can formally call it as accounts payable. Nonetheless, whatever that name is, that's going to go up under the liability with the same amount. So my net change on the asset side is X. My net change on liability is X plus 0. So you see, again, my equation gets that. If this value of, let's say, the raw material of 10 rupees has been sold for 12, what is A is equal to L plus C in that case? Then your raw material from the asset side is going to go out. That's the value in your books. You are going to get cash. Cash is again an asset worth 12. Oh, you made a profit of 2. Profit belongs to whom? Profit is an income. And income belongs to the capital providers, the owners, plus 2. So how much is your net change under the asset? Plus 2. How much is the net change under the liability? 0. And how much is the net change under capital? Plus 2. So do you see that my golden equation, my magical equation, A is equal to L plus C, gets to tally here. So my double entry system simply means that while recording, you have to record it at least at 2 places. All right. So I better be closing this particular video. It's absolutely been fantastic talking to you like this. Just make sure that your understanding of the business transaction is absolutely spotless. If that is the case, I can be absolutely sure that you will be a very good accountant. If your step 1 is clear, your step 2 will automatically become much easier. Okay, with that, absolutely good to close this video. Thank you very much. I'm super duper excited to tell you something which is a substitute of debit and credit, which is this A is equal to L plus C, right? Looking forward.